This is Ryan Coombs, Vice President of Research and Strategies at Carty & Company. Here's your weekly market update ending the third Friday of February 2016. In the economy, the number of Americans filing for unemployment benefits unexpectedly declined to a 3-month low last week. Initial jobless claims dropped to 262,000, the lowest since November. Wage growth was stronger than expected in January. Average hourly earnings rose 0.5% since December and 2.5% since January 2015. Americans' expectations for the economy declined in February, as optimism propelled by job growth and cheaper gasoline at the start of the year faded. The Bloomberg Consumer Comfort Index, which tracks the U.S. economic outlook, dropped 4.5 points from what was the highest level seen in 7 months. Treasury Secretary Lawrence Summers said this week the biggest challenge for the U.S. is getting inflation to move toward the Federal Reserve's goal of 2%, adding the central bank should put off raising interest rates again. The Consumer Price Index, an important inflation gauge, increased by the most in 4 years on Friday. Excluding volatile food and energy prices, CPI jumped 0.3%, while year-over-year core prices rose 2.2%. At Carty & Company, we have educated clients since early 2015 that inflation is a factor that should have been taken into higher consideration when the FOMC decided to raise interest rates in December. We went as far as asking this exact question directly to St. Louis Federal Reserve President James Bullard. His response was, "The FOMC currently weighs the unemployment rate and jobs report more heavily than inflation when deciding the Fed funds target rate." One way to ensure a rate hike is reasonable for the FOMC in the future is to measure before adjusting for inflation that gross domestic product is growing at a fast enough pace. The Fed should consider focusing on nominal GDP to help guide monetary policy. This approach would help the central bank to better gauge the extent of weakness in the economy given that inflation has remained low. In fixed income, there has been a massive divergence between recent economic data and the U.S. Treasury yields. The yield on the 10-year debt fell below 1.6% this month before recovering back to over 1.75%. The Atlanta Fed's GDP Now indicator provides an estimate for quarterly economic growth based on recently released economic data, which currently stands at 2.6% GDP forecast for the first quarter of 2016. A chief economist at Deutsche Bank said this week, "Using the historical relationship between the Atlanta Fed GDP Now estimate and 10-year rates shows the 10-year should not be at 1.82% but instead 2.3%. Put differently, markets are currently pricing a deep recession, but that is simply not what the data is showing." California will see a larger decline in municipal debt supply over the next 30 days than any other U.S. state, according to data compiled by Bloomberg. The amount of debt from the most populous state is set to shrink by $2.3 billion, as bonds are paid off faster than new ones are sold. Alabama, on the other hand, is trending in the opposite direction. The supply of securities from the southern state is poised to grow by $1.5 billion, more than anywhere else according to the data. U.S. stocks fluctuated as they headed towards the strongest weekly advance this year, with gains in technology and financial shares offsetting declines among commodity producers and a sell-off in crude oil. Friday's trading saw several declines and rebounds reversed, with Applied Materials' 9.1% surge helping to buoy technology shares after a predicted sales this quarter may beat analysts' estimates. Chevron Corp and ExxonMobil Corp sank at least 1.1% each to weigh on the energy group. Defensive stocks that investors tend to flock to during times of volatility are currently at the highest prices relative to profits in 12 years. Companies that provide essential products and services like Campbell Soup Company and Kellogg Company, which are in the staples sector of the equities markets, are at 21 times earnings. That multiple is more expensive than everything else in the Standard & Poor's 500 index, apart from energy shares, whose income struggles distort that comparison. People are paying a higher valuation to the greater probability that their capital is going to be preserved in these defensive sectors. But at these valuations, investing in them is hard to justify. That sums up your weekly market update ending the third Friday of February 2016. For more details, please visit our information center at www.cardico.com. And for real-time updates, follow us on Twitter at Fixed Incomes. Thanks for watching and have a great week.